Hey everyone, this is Kirk here again at Option Alpha. So this is the members only video. It's about 7:15 on Monday morning. So I wanted to send out this updated video for the Iron Condor traders, just to kind of give you guys some insight into what I'm looking into as far as adjusting this 1 April Iron Condor that we have on right now. Now, please watch this video completely because I'm going to go over a lot of things, so it may be a little bit long, but I think it's going to be really helpful to you guys. As it stands this morning, the futures are just slightly higher, so we'll see where it goes. I think it was a good idea to hold off on any adjustments until today, if we make any today. And but I think that this weekend we got some really good time decay working in our favor, so we didn't see the markets drastically higher. I would have liked to see them lower, obviously, when the futures opened up, but I'll take flat to a little bit higher right now. So 10 days till expiration, so that's going to be playing in our favor. As always, time is on our side here, so every single day that the market doesn't rally past our levels, this is a good day for this position, so we can just try to hold out on whatever adjustments we want to do until then. So I wanted to go over the actual trade alert that we made on March 24th. So it's pretty good. I thought it was a pretty good trade alert. I think the one thing that I think we could have done better on this, or I could have done better on this, was not make it lopsided to the downside. But looking back, you know, where the market was, we had just come off of a pretty good rally, a pretty short jump higher, and I thought that you know, at least we were in for some more downside volatility. So as always, you want to leave more room on the downside, and I still think that was a good idea to leave more room. We could have obviously moved up this just a little bit, maybe the downside spread that we had, instead of being at 700 for the first strike, we could have maybe moved it up to 720 or so. But it really wouldn't have made a difference. I wanted to leave more downside at the time. So that's obviously the risk that we are running with Iron Condors, is that we have to get pretty close to the market when there's low volatility times. So when the market does make a straight moonshot like it's been doing over the last couple of days, that obviously puts one of the sides in jeopardy. So the 700 side that's below the market now is practically worthless. I don't even think you could probably close it out if you wanted to, because there's really no volume on it. It's practically worthless. That actually ended up being the higher value side of the Condor at 20 cents per contract. On the top side, we entered it with about 10 cents as far as the call spread. So we're taking a little bit of a bath right now. I'm going to go to the Thinkorswim chart. Obviously, you can see that since we entered that trade, the market has gone straight up. So that obviously doesn't work in our favor right now. But now that we're under 10 days to go here, I think that it's going to really speed up the time decay. This is going to help the positions, and especially if the market does, God forbid, make any sort of pullback. I know that's crazy to say right now because it seems like every day is higher. But if it does make some sort of pullback, then that's obviously going to help our position. Now, I wanted to go to the Analyze tab here and just analyze the couple different options that we have working in our favor. No pun intended. And I wanted to first take a look at just the overall Delta, Gamma, Theta, Vega of mainly the 870 positions, because those are the main ones that we're concerned about, that first strike price on our 870, 875 call spread. And you can see here that the delta is about 19 for these positions, and these really haven't adjusted for today's open, so I think they may be a little bit higher, or the delta may be a little bit lower, and actually theta may be a little bit higher. But the delta right now is about 19 for these positions, and the theta is about 32. So you can see here that even a pretty good move higher in the indexes, at least this week, is not going to yield as much movement in the underlying price, because time decay is now starting to really speed up, and we're going to start to see time decay get up into the 40s, 50s very quickly on this position. So every day that the market does move higher, if we get a flat day, then that's going to be 32 cents right off the top, which is going to be really good for these premiums. So if I actually go and just switch it to our general option writing, and switch it to vertical spread here, you can see that the 870s closed out the week last week at about 92. So again, that's about an $80 loss that we have right now as the position stands. However, I think it's going to move down to at least a $90 loss when the markets open this morning. The good thing is that we still have some good distance between those two. So Although, as much as I would like to make an adjustment today, and I might make an adjustment today, depending on how the markets shake out, every day that we can wait, like I said, is going to be really good for this strategy. I think that the two options that we have going forward are to either roll the contract higher to a higher strike price set, like the 880s and 885s, and or to buy a call for the time being and take advantage of any upside move. So I want to take a look at both of those options real quick. This is a profit loss diagram of just our basic vertical spread down here that we have. Again, you can see entered it at a $30 credit. So this is where the market is right now, this $30 credit. So this is what our payoff diagram looks like at expiration, and this is this blue line here. You can see we profit anywhere really below 870. If the market closes anywhere below 870, we profit at expiration. Obviously, if we let it just roll over to the end, then we make a $470 loss on this side. On the red line here, this is our profit loss on the day. So this takes into account some of the time decay feature that's still left in the option. So to learn more about this, you obviously have to go and watch a couple trading videos, but I'm not going to go over too much of this right now. But this dotted red line here in the middle, this is where the RUT is trading right now. So you can see on the daily, we're losing about $70 on this trade, at least on this leg of the trade, right now as it stands if everything were to close out. But if the market stayed right here, obviously time decay would eat away at this position and we'd have a profit. So our two options, we can one, roll the contract to a higher spread. And when I say roll it, I mean close out this one, close out the one today, buy it back for 90, this side of the spread, and then go out and resell another contract at a higher strike. So I'm actually thinking that if we do that, we're going to try to go after the 880s to 885s. I don't want to sell and roll too early as there's 10 days left and then have to do it again and have two rolls in the same contract month. So I'd like to wait as long as possible and try to roll and get as maximum amount of premium while also not getting too close for the market even with the roll, because a roll in the RUT at this point today, if the market moves up another 5 points, then we've basically done nothing except reduce or increase our exposure again and rack up commission costs. So if we do roll, we're going to roll to the 880s to 885s or higher. If we can get the 880 or 885 spread for 50 cents, that'd be great. And I'm just going to show you what that profit loss would look like. And again, you can see that now we've moved out our profit loss target to a more reasonable level out here. We've moved it from the 70 in here all the way out and shifted this exposure all the way out to 880. This would probably be the ideal trade if we are going to make something of this trade. The other option that we have is to buy, you see down here, a single buy, one RUT 875 call, or even an 880 call. But the basic idea here is that now we've shifted our entire payoff diagram higher instead of lower. Now the risk here obviously is that when we bought this call that it erodes very, very fast. So if we buy a call and the market moves higher, then that's great and we take advantage of that call premium that we earned. But since time decay is working in our favor as an iron condor trader, it's also going to be working against us as a long call trader, especially with 10 days left in the expiration cycle. So if we do buy this call for 180 and we don't get any movement in the RUT quickly, then this call could erode very, very fast, and that would create a pretty good loss. We'd have kind of no control over trying to buy, well, we'd have control over buying that back, but we buy it back at a substantial discount. So maybe we buy it at 180, and then we'd have to sell it back to get out of the position before it completely erodes at maybe like 120. I'm not in favor of that particular strategy because it only takes advantage of just the time decay feature and just the volatility premium. I don't think there's much left in the way of real value in these long calls at this point. Would have been better to do this last week, but if we did this last week and with the markets opening pretty flat, we would have seen massive decay in this as well over the weekend. So it's really a tricky line that we're kind of walking here. There's so many different options as far as what you can do with these condors to adjust it. My personal preference is to try to roll these higher and reduce our exposure, just move out a little bit, take a little bit less premium, and maybe even take a flat no premium on the month for these condors. That would be my guess as to what we would do. But again, we will keep everyone updated with what's going on throughout the day today. If we do anything today, we'll let you know, obviously. My hope is that we just wait out a little bit and let the market maybe march a little bit higher, but the time decay feature is going to be really good for us. Finally, the last option that we kind of have here is to move up this 700 strike put and maybe create another credit spread, maybe somewhere in the 770 region, to again take advantage of some of the premium that we're going to be losing by rolling this contract higher. So again, a lot of options, but I wanted just to do this video to let everyone know what's going on in the market so that everyone is fully up to date. As always, we'll let you guys know, and if you have any questions or comments, please email us. Happy trading.